Well, thank you for coming. Thank you for, I tell my kids that they can either spend their time or they can invest their time. And so I'm glad that you chose to invest the next 54 or 55 minutes with me so that I can share with you a little bit about the reverse mortgage and kind of maybe dispel some of the negativity around the reverse mortgage. And you know what, let's just hop right in. So I want to show you, this is what we're gonna go through. I'm gonna talk about myself just for a minute just so you know who I am and why I'm doing this. And I'm gonna show you, I'm gonna do the reverse mortgage in 1 minute or less, and then we're gonna talk about end of life stuff, some retirement risks. We're gonna talk about some current financial statistics. Then I'm going to dig a little bit into reverse mortgage details, and then we're going to kind of circle back and connect the reverse mortgage to the risks that we talked about. And then when we end up, if we have time, we'll talk about a couple different reverse mortgage scenarios and talk about how you can use this information right away if you choose. How does that sound? Sound good? All right, let's get started. You know what, if you have questions along the way, please don't hesitate to drop them into the chat box there. And Jen, if I don't see them, I would rather that you just interrupt me and say, hey, what about this and what about that? If you want to turn your sound on and stop me, totally fine. Just that's absolutely okay, because I'm doing this so that you can get as much information as possible. So I don't want you to get to the end of the hour and not have your questions answered. Okay, so who am I and why am I here? So I'm a local Puyallup guy. I grew up in Parkland. I'm a dad and stepdad, and I was in real estate for many years. I was at Keller Williams, and I was started at Windermere. I actually started in the office that I work in today when it was a Windermere office way back in the day. I've been in mortgage for about 6 years. The whole time I've been at Fairway, so I've never been anywhere else. This is a big thing for me. I believe that home ownership changes people's lives, and I've believed this for a long time. But recently, I found a study. It was published in 2017, and in that study, it says that people who own a home when they retire are 89 times more wealthy than people who didn't buy a home. And so the article's fantastic, and you should absolutely read it and have it and use it and give it to people, because 89 times, it's not 89%, it's literally 89 times, 89x more wealthy than people who don't buy a house. What the article says, what's interesting, is the article tries to make the case that, well, they're 89 times more wealthy, but it's not all in the home. Absolutely, it's not all in the home. But here's another thing that is not talked about in the article that I see, and that is a concept called time preference. So I've learned a short time ago that in behavioral economics and social psychology and all that kind of stuff, there is this concept of time preference. People with a high time preference tend to prioritize things in the near term and want things in the near term, and they tend to look near term. People with a low time preference tend to look farther down the road, tend to look at things farther down the road, and actually behave like there's literally a farther down the road to have eventually. And so what I think, my theory is that not everyone has a low time preference that buys a house, because sometimes, you know, they just gotta get away from mom, or they want to invest in their future and stop paying rent, all those wonderful things. And once they get in that position where they own a house, they're starting to look a lot farther down the road. So their time preference lowers. They don't need things right now, and they're starting to look farther down the road. So then they do other things that reveal their low time preference, like they invest more in their IRAs or their 401ks or their kids' college savings plans or their HSA at work or whatever. And that, I think that is what changes financial lives. And also, I think that what changes lives about owning a house is the richness of the memories built around rituals. And I think that People don't really talk about that very much. But anyways, that's why I do what I do, because I think owning a house absolutely changes lives every single time. Every single time. And I think you'd agree with me on that. I'm a home ownership advisor, and I'm a home keepership advocate. I think you should keep your home. I think if your home, if you can afford to keep it over time, it will serve you better down the road. Keep it and buy another one. Big, Art of Home Ownership Advisor just means that I believe that a 30-year loan should have a 30-year lender. That's what I think. What do? I help my clients protect, acquire, protect, maximize, and utilize home equity so that they can have the best life possible. And by best, what I really mean is most rich. I think that rituals and memories in a single house or a couple houses versus a new rental apartment or a new rental house every year looks different in a person's rearview mirror, and kids, if you have a family, that sort of thing. Okay, that's me. That's why I'm here. That's why I do what I do. Let's kind of shift gears and talk about end of life. I'm going to ask you guys a question. I can't see your responses, but I'm going to ask you a question. What do you think is the biggest? Lots of these questions, a lot of these studies have been done. What do you think is the most common fear around end of life, around dying? What do you think that is? People are afraid they're going to run out of money. This is in the top three, depending on which study you look at. This not. They don't want to run out of money, and they're afraid they're going to run out of money. That's the top. That's the top three. In the top three also is they don't want to be a burden on their kids or others. And the last one, they don't want to spend final days. My grandma used to say in a home, but they don't want to spend final days in an unfamiliar place. And I believe, and I hope you'll see here within the hour, that in certain cases, the reverse mortgage can absolutely help people to move into a position where they have a lesser likelihood of running out of money, lesser likelihood of being a burden on their children, and also a lesser likelihood of spending days in a strange place. Let's talk about retirement risks. Gosh, I wish I could see everybody's. Can I see it? Can I see chat? Okay. I think that most people, when they are talking about anything when it comes to a retiree or anything like that, that people tend to think that life always goes the way it's been going. So when younger people like me at 51 or my kids in their 20s talk about retirement, it's very easy to base it on experience of the life that we've already experienced and not be able to make it easy to put ourselves in that place where the risks are different and the penalty for having any of these risks jump up generally gets greater with age. So depending on where you look, you'll find about anywhere from 6 to 16 common retirement risks. And I'm just going to go through a handful, we can lay them out, make a little case for each. Can you hear me okay? My audio had to change. Yes, okay, awesome. So longevity risk. I run the risk of outliving my money. We are in this spot right now where people are just living longer. You're going to live longer. I'm going to live longer. Our kids are going to live longer. And the problem is we didn't save like we were going to live longer. Most folks in that retirement spot right now. Another one is inflation risk. Raise your hands, since I can't see your thing, raise your hands if you're concerned about retirement or about inflation risk right now and you're not even a senior. You're not even 70. Absolutely. Yeah. Sequence of returns risk. If a person is going to retire and they have a big chunk of money in stocks, bonds, and mutual funds, and the first couple of years the market does a 50% dip, if the market takes a 50% dip, how much does it have to jump to go back to where it was? It's not 50%. The market goes down 50% in order to get back to where it was. It has to move 100%. So if someone is living off of their funds and they have a bad couple of first years, that could mean a whole different retirement trajectory financially. Loss of spouse risk. I've seen this before where husband and wife, husband works his butt off all his life, wife works her butt off all her life. When it comes time for him to sign his pension paperwork, he's super healthy, takes his vitamins, exercises every day, feels like he's going to live forever. And if he takes the life-only pension, then it's a lot more money, so he'll have more money for goofing off and traveling and flying and whatever. And then 6 years into retirement, like the math says, he dies before his wife, and that life pension goes away, and now her income has dropped significantly. It could go either way. That's a significant risk that most people don't talk about. Spending shock. In my opinion, this one hits most people and hurts the most, and it is just when life expenses come up that weren't planned and do not have some sort of insurance coverage. That can really ruin this. We got, look at that, inflation risk twice. Probably should have been mentioned twice. Long-term care, 70%-ish of retired adults right now will need some form of long-term care, and less than 10% have some sort of long-term care policy. Washington state policy doesn't count. That's horrible. New one is legislative risk. This one wasn't even talked about years ago, very much at all. But today, because of developments over the past couple of years, we've learned, especially as real estate agents, that we have homeowners that might own a rental, and there could be legislative risk in the possibility that they might not get paid rent for a significant amount of time. So there we go. Those are our legislative risks. Okay. I'm not going to read this one to you. This basically, we have an aging storm. Lots of people are turning 10,000 people are turning 62 every day, and what the rest of this slide says is they are undersaved and underinvested, and expenses will be significant. So after this little bit, we're going to talk briefly about the reverse mortgage, and then I'm going to go through a history so you can see the development of the reverse mortgage. It's not a brand new product. The first reverse mortgage, first HECM, home equity conversion mortgage, was originated in 1989. Like I said, the most common reverse mortgage is the HECM. There are other private reverse mortgages, but they are not federally insured. The reverse mortgage is it basically has one regulating department, which is HUD, so they're the regulator, and then it has one insurer, and that's FHA. So the home equity conversion mortgage is federally regulated and federally insured, highly regulated. This is the reverse mortgage in a nutshell. If you want, grab a piece of paper, write this down. Can I move this? Yeah. There we go. Okay, boom. There we go. Home equity conversion mortgage is a federally insured, adjustable rate, payment optional, negatively amortizing loan product that allows eligible homeowners age 62 or older to access a portion of their home equity in the form of cash, monthly payments, or a growing line of credit. That's it in a nutshell. Unfortunately, when they came out with the reverse mortgage here a handful of years ago, there were not some guidelines in place that allowed the reverse mortgage, when used with borrowers that should not have used the reverse mortgage, caused significant damage. Some of those people, I recently met with a lady named Nina here in Tacoma. Nina did her reverse mortgage in 2008. And when she did her reverse mortgage, they didn't ask her how much money she made. They didn't ask her about the condition of the property. They saw that she had the equity, and they gave her the reverse mortgage. When I met with her, I found out that she only makes $440 a month. That's her total income. With $440 a month, she doesn't have the money to pay the property taxes, and she doesn't have the money to maintain that property. keep a roof on that's not leaking. When I met with her, the roof was leaking. And also put food on her table and maintain the safety and security of her home. That was bad, and that's happened a lot. And the reason, so HUD and FHA, HUD specifically, they looked at these damaging stories, and over the years, and we're going to go through the chronology real quick so you can see the development. Over the years, they made some significant changes, and most of those changes actually, and this is what kind of freaked out the loan officers around the nation who did reverse mortgages. Every time that HUD would create a new sort of guideline, they narrowed the borrowing pool. So they chopped those folks out. They're not eligible. They chopped those folks out. They're not eligible. And the reason why was to protect them. Well, the industry's saying, oh, nobody will ever do any reverse mortgages, as the pool of borrowers narrowed to be more and more narrow. I think it's a great thing because people shouldn't ever be damaged by a financial product, ever. Talk to the SEC about these things. Okay, so on this screen, we can just see here, reverse mortgages. The concept has been around for a very long time. 1961, first one was done back in Portland, Maine. I highlighted the important stuff here. In 1989, like I mentioned, that was the first FHA HECM that was issued. Next big year, so we didn't have a whole lot of big stuff going on through these years here. Big year 2009, FHA introduces the reverse for purchase. So now instead of someone buying a house, so before 2009, someone could buy a house with a forward mortgage and then utilize a reverse mortgage to refinance. And then, they have all the costs of closing costs twice and that sort of thing. That's not a great deal. So they said, let's make it a purchase loan. So now we can use the reverse mortgage as a purchase loan. Other big dates here, 2013, there were several changes that were made in 2013, including non-borrowing spouse protections. They changed withdrawal limits. So they saw that the judgment was people were potentially taking out too much money at the very beginning of their reverse mortgage and putting themselves in a unnecessarily risky position. And then next big one, 2015, guidelines for the financial assessment were rolled out. This is where the reverse mortgage fell down for Nina. There was no financial assessment required. The financial assessment now it requires that the borrower have enough money to maintain their home, and there's a per square foot dollar amount on that, and also maintain themselves. There's a per person dollar amount on that, in addition to have enough funds to live the rest of life. And so that is required in the form of residual income. So income that's going to be there regardless, as long as they're alive. And she didn't have that. So the loan put her in a really bad spot. Other guidelines in 2017, there was also some pretty significant changes in 2018 in terms of loan limits and mortgage not origination fees, but mortgage insurance, the FHA insurance. Lastly, in 2021, just very, very recently, they actually made additional changes to protect non-borrowing spouses. So I do some work with, I help out with the Tacoma-Pierce County Association of Realtors with their lawyer referral line, and we got a call from a gentleman named Harry, and I went out and sat down with Harry and his wife, and they did their mortgage, their reverse mortgage, 2006, and she's significantly younger than him, and at the time there was no non-borrowing spouse thing. She's just not on loan. So to help out borrowers in that position, because up until very recently they would have had to do a refinance to put her on the loan. Now they don't have to, because of right here the new protections for eligible non-borrowing spouses who were married at the time that the loan was originated and have stayed together and occupied the house the whole time. So that's really great news. No one in the industry wants someone to be hurt in any way by a reverse mortgage. So because of those changes, the big changes were the financial assessment. Now that's required. The inclusion of the non-borrowing spouse. So now somebody's not left out. Because of those changes over time, the reverse mortgage has become a really very sexy retirement income planning tool. So Robert Burton, he's a Nobel laureate, the guy knows math. He says reverse mortgages are a powerful yet largely untapped tool for retirees to improve their standard of living. This is going to become one of the key means of funding retirement in the future. Jamie Hopkins, who has lots of letters after his name, he's younger, he's a little bit more spirited, and his thing is, he basically says, look, you're just silly if you don't include it in the plan. So they're not saying use a reverse mortgage. That's not what they're saying. They're saying if 50% of America's senior homeowners have 60% or greater equity in their house, and they're not including that equity in their retirement income plan, that's just silly. So here are some advanced financial planning options. Some people believe that the reverse mortgage is only for people who have not managed their money and are house rich and cash poor. And actually the truth is that it doesn't matter where one of your clients sits on the wealth spectrum. What question is not will they benefit from a reverse mortgage. Sometimes it's often what will the benefits be, because the higher net worth folks, those folks tend to utilize a reverse mortgage for tax advantages and for legacy planning and that sort of thing. Their long-term capital gains planning, long-term care planning. A reverse mortgage can come in handy very much in a silver divorce situation where there's only one house and incomes for one or more of the borrowers is not going to go up. Insurance premiums management, sequence of returns, risk mitigation. This one is fascinating because, like I said, we talked about it earlier. Actually, lots of money in the investment accounts, and a bad couple of years straight out of the gates that could change a person's life trajectory significantly. Portfolio management, legacy planning. Like I said, there could be tax planning involved in terms of tax deductions and that sort of thing. Don't want to really get deeply into those. All right, how are we doing on time? Okay, 11:28. Reverse mortgage eligibility basics. At least one of the borrowers needs to be 62 years or older. There are proprietary products that have a minimum age down to 60, but I don't do a lot of work with that. I like to stick with the federally insured mortgage. The home has to be FHA qualified. In other words, there's going to be an inspection every time, and it needs to meet the FHA inspection guidelines. The borrowers must live in the home for more than 6 months out of the year. Has to be their primary residence. They can't do it on an investment. They can't Airbnb the property. Also, that's in the big, not necessarily fine print. They have to attend HUD counseling. This was a thing that one of the changes that happened a handful of years ago. They said we need these borrowers and any interested parties to attend a counseling session, phone call or in person, with a HUD-approved counselor that is going to help them make sure that they understand the commitment that they're getting into and the details of the loan. They can typically emphasize the loan, that sort of thing. They have to pass the fiscal assessment. That's a requirement. Obviously they have to have sufficient equity in their house. So here's some of the details. They get to keep the title of their home. It's just a loan. That's kind of the only line I like from Tom Selleck, and it really sticks from his commercials. But it's just a loan. That's all it is. They keep the title for their home. We have to run a credit report, and bill paying history, tax paying history, and homeowners insurance paying history is very, very closely looked at. But credit score is not included. And there are, of course, like I said, income calculations due to the residual income requirement for each loan. It allows the homeowner to have tax-free cash We're not supposed to say tax-free, even though this is a fairway slide, they put tax-free on there. In some cases, somewhere on the planet, there could be some sort of tax involved, but the dollars from the equity is a loan, so proceeds from a loan are not considered income by the IRS. There's never a monthly payment. The homeowner is responsible for maintenance of the home. They got to keep it up because the lender has an interest in making sure the structure doesn't fall apart. They have to pay the property taxes and the homeowner's insurance and any sort of dues or fees if there's a special assessment for the yard or anything like that. They have to pay those as well. Okay, so here's a couple of great benefits. Let's get this out of the way. Okay, so the reverse mortgage does not require a payment. Payments are optional; they're not required. With the HECM, a borrower can make a payment, and that's kind of a little bit going down a little bit too much of the detail. So if you have questions at the end, we can talk about that. No payment until the last living borrower leaves the home or the borrower chooses to sell the property. No one owes more than the home value with the FHA reverse mortgage. And with the reverse mortgage, a purchaser can utilize the reverse mortgage to purchase a home. So they can move from the home they're in to a new home that might be better, smaller, easier to manage, or closer to family. So a lot of people ask, okay, so how do we get this money? If this equity is available, how is it available? The first form is in a lump sum. They can use this lump sum to purchase a home, or they can use the lump sum to finance their current home. For instance, let's say they're both people are 65 years old and they have a $45,000 balance on their current home. They don't have to wait till they pay the balance off to get that reverse mortgage. They can get the reverse mortgage, and the reverse mortgage can pay off that first loan, and then they would start their reverse mortgage balance with the fees, all the fees that are involved, which are significant, on top of that reverse mortgage, or the balance from the first mortgage. They can have the funds available in a line of credit. That line of credit is non-recourse as long as the couple or the individual borrower maintain the home and pay the property taxes and pay the homeowner's insurance. In other words, they don't violate the terms of the loan. Then that line of credit cannot be canceled, cannot be frozen, cannot be reduced, and it's always there, and it's always going up. It always grows in value until it goes down to zero. So if they use the whole line of credit, it's not going to grow anymore. Like I said, guaranteed growth. They can also get the access to funds in monthly loan proceeds. They can have those loan proceeds as a 10-year payment, so not 10-year, but just they can start today, calculate out till the end of their life. When they figure those amortization schedules, they figure that the borrower is going to live to 100. So they'll divide the amount of equity available in the loan and break it up over 27 or 37 years evenly. And then they can also do a term payment. Term meaning they can decide that they want to get a payment from month 18 of the loan to month 26 of the loan because they need some money for taking an adventure, something like that, or any combination thereof, which again makes it moves it to a pretty sexy retirement income planning tool. Okay, so in terms of property eligibility, 1 to 4 unit properties, like I said, FHA, got to be FHA approved. Manufactured homes, double wide, we know this one. Condos must be approved, FHA approved condos. I've heard of them doing spot approvals recently. And urban developments, townhouses. The townhouses can be possibly or not. If it's a townhouse and it's freestanding and it's not in a community that has CC&Rs that make it not viable, not accessible, not usable. Properties held in a living trust can do it. Those in Texas. Okay, so are we good on time? Excellent. The reverse mortgage as a purchase loan. since it can be used as a purchase, there's a cajillion different ways that it can be used to benefit the borrower so that they can have more house to buy, or benefit the borrower so that they can have a house that they can afford in a different neighborhood because maybe they have increased their purchase capabilities or the amount that they can spend. Let's just go through these. Many 55 plus communities are eligible for a reverse for purchase, so that could be a fantastic thing. Like I said, you increase your client's purchasing power when you use a reverse for purchase and their flexibility, potentially, because if they were planning on paying cash at $600,000 and their retirement savings is not significant, and maybe they don't have long-term care coverage of any policy of any sort, potentially, instead of dropping $600,000 on the house, if they could use a reverse mortgage and put down significantly less and take those other dollars and put them somewhere where they're going to go to work for them. Registered financial advisor would be the person that talked about that. No monthly mortgage payments, just tax and insurance maintenance required. They could move closer to family. What I've been talking about a lot over this past really 2 years is the couple that might live in Boise, and we're planning on selling over there as soon as Joe retires and moving back over here and paying cash for the house by the kids. And heaven knows that their house went up in value over there in Boise, but what if the house over here they're planning on paying cash for near the kids went up $200,000 in value, and now they're out of the money? What are they going to do? Well, they can live farther from the kids and be less happy with their house, or they could potentially utilize a reverse to have more neighborhoods available for them. Like I said, they purchased the home for somewhere between 30 and 50% down. There is a formula here, and it is how much the down payment is based on the principal limit factor, basically their age and the value of the home and the interest rate of the loan. On the purchase, lots of people, I think, assume that reverse mortgages take a long time. They do take a long time when it comes to the meeting parts, the hanging out with the clients and getting to know them and asking all the questions and making sure all the documents are signed and all that. That's a longer sales cycle. It's not unusual for me to meet with a client for an hour and a half, 3 or 4 times. And that's just the one client. But once we're ready, once we've got our I's dotted and our T's crossed on that fairway, we can do a reverse mortgage, reverse for purchase. We've done them in as little as, well, it's actually less than 17 days, but we're calling it 17 days now. So we've got that down pretty good. Okay, remember when we talked about retirement risks and what the retirement risks are, and now that we know that, you know what? Hold on, I want to show you something real quick. Check this out. See if you can hear this. This is my reverse mortgage in a minute, and I totally skipped this. My apologies. Let's do this. See if you can hear it. How does the reverse mortgage work like this? Hopefully, when we get to our retirement, we've been saving for a long time. We need that. Some folks, when they retire, will also have purchased a home along the way, and that home will have equity. What a reverse mortgage does is it allows us to take a portion of that home equity and turn it into housing loan so that it can be included in a comprehensive retirement income. Simple as that. You still own the house, still have your liquid assets. Now you have a small portion of that equity that you can include in your retirement income. That's how a reverse mortgage is. Okay. That's my reverse mortgage in 1 minute. I apologize. I told you I was going to do that earlier. Okay, so here's the thing. If we run the risk of outliving our money, how or in what ways could we utilize a reverse mortgage to have some impact? Well, one might be using the H for P is reverse for purchase. So if they're in a house that's too big and doesn't work for them anymore, but there's significant equity, there's a possibility that there more dollars could be added to their retirement income plan by selling the current house and using a reverse for purchase on the next one. Inflation risk, also H for Pete, also a 10-year payment or a term payment. Loss of spouse risk. If income drops by 50% or more, then this would be one way to utilizing a reverse for purchase could be one way to leave the remaining spouse in a better financial position. Also, a 10-year term payment could work there. When it comes to spending shock, all of a sudden there's a $10,000 bill on the table. How we're going to do this? Lump sum could come in super handy there. Or the line of credit, or a 10-year or term payment. Lots of different things depending on just like the nature of that spending shock. When it comes to inflation risk, yeah, we talked about that. Sorry, did it twice. Long-term care, line of credit all day. Homeowners are 62 years old and they've got significant reserves, but they don't have a long-term care policy that's actually long-term care. By the way, I don't know what the research says, but pretty much no one I know, I would say less than 1 out of 20 people that I've talked to understands that Medicare and Medicaid and VA are not going to give you any sort of long-term care benefits. There's no long-term care there at all. And I think most people don't understand that, which is terribly unfortunate. Legislative risk, that's a good question. I don't know, because legislative risk is one of those things that we don't know when it's going to show up and what it's going to look like and how bad it's going to hurt. Okay, so let's do a scenario real quick. Look at this one. This is Harry and Louisa. Harry is still working to pay off their remaining $64,000 on their mortgage, and then he's going to retire. Awesome. Sounds like a fantastic plan. They've got $100,000 in their combined retirement accounts. What I didn't tell you here is their Social Security income, but we're not going to get super deep in the actual financial planning of the thing. So they have a 2-story, 2,200 square foot home on a third of an acre. It's down near downtown Puyallup. And the real estate agent that they're working with told them that it's worth probably about $550, and their current monthly payment is $1,275. About 400 of that ish is maybe 420, or about $400 is, we're going to say, is property taxes and hazard insurance. So one of the questions that we always have to ask is not just how's the house, but what are the expenses that are coming? Because if we're planning to retire in this home, we need to know that we've got 8 years left on this roof max, or we've got 30 years left on this roof, or we've got no years left on this roof. And so their current situation was that they had a new roof and a new exterior paint in 2006, and their HVAC was about 10 years old. And what did they decide to do? They decided they're going to sell their home, buy a $500,000 3.2 Rambler with an updated roof. Got a 30-year roof on it, new 30-year roof. It's got a new HVAC. It's got new paint, and it's a little bit closer to the kids. How'd they do that? Well, my quick math says that their sale proceeds is about $436,500. So what we did there is I took off the cost of sale and I took off their first mortgage that got paid. So left them with sale proceeds of $436,000. Oh wait, yeah, that's right. Okay. So they decided that they're going to use a reverse for purchase to purchase that new sexy new Rambler, and because of their age, that it cost them a total out-of-pocket down payment plus closing costs of $265,719. What happened next, though? This is the crazy part. $170,000 now they have in sale proceeds in their hand. What are they going to do with that? I would think that because they only have $100,000, remember they have $100,000 in their combined retirement accounts, that $170,000 could be used for a handful of things. One, if they also had a maybe a car payment. Maybe they recently bought a new car that's going to be the one that's going to last them for 20 years or so. And they figured they would bite the bullet and go ahead and take that payment. Well, in this situation, let's say the payment's $350 or $450. They could take a portion of these proceeds, pay that car off, and now their net cash flow, their net monthly cash flow has increased by the principal and interest portion of the payment that they're no longer making on their house, in addition to that car that they got paid off. And then they maybe put $135,000 or so, say, into the hands of their registered financial advisor, who is going to help them protect them from other risks down the road with that money, or build legacy wealth, or both. Okay, how are we doing on time? This next tool is going to take, it's about a 12-minute deal. So I'm wondering, should we go through it? Would you like me to walk you through this next scenario using a tool, or do we have questions that I can answer, that you would like answered? Jen, can you see if anybody says anything?
Let's see. Anybody have questions? Raise your hand. No? I don't see any questions.
No questions? Okay. All right. But I'm going to go through, what I'm going to do is I'm going to go over here, equity tracks. Okay, everybody can see my screen okay? There we go. So Fairway recently partnered with a company called that has a financial services software program called Money Tracks, and they created Equity Tracks. Equity Tracks I love it because I'm a numbers geek, and it allows me to be able to turn numbers into pictures, and people like pictures. So in this scenario, what we're comparing a reverse mortgage refinance to a forward mortgage refinance. Property value is $520,000. I figured the home appreciation rate at 3.5%. This is what it has been for the last 95 years in Washington State, compounded annually. Loan amounts are right here. Higher loan amount on this side because what he wanted to do was do cash out. So this is either a forward cash out, so I could put a bunch of money in my pocket and have that for retirement down the road, or I do a reverse, and maybe this has a more significant impact on my holdings over time. Okay, so interest rates, pretty close, comparable interest rates. Age of the youngest spouse. So the loan amount, one of the big numbers that matters is the age of the youngest spouse in creating the figuring out what the loan amount is. On this side, it's a 30-year loan. What I did was I said, okay, since this borrower is going to be not making a required monthly principal and interest payment anymore, what I'm going to do is we're going to take $400 per month, and we're going to make a payment on our reverse mortgage. So we're adding to our cash flow by removing the principal and interest required payment, and we're just going to do an optional monthly $400 a month payment. At the beginning, what we did was this client has about $80,000 in savings, and on the scenario on the right, this is with the cash out dollars. So did the loan, took some cash out, added it to the savings account balance. All right, so let's hop through and show you what we do here. I'm just going to compare both. So we got the reverse mortgage on the left, the forward mortgage on the right. This liquidity bucket, that's our savings account, plus our line of credit. So we have savings dollars, line of credit dollars. That's our liquid funds. On the forward side, we're going to start out with the liquid bucket at $166,000. And one thing that I didn't mention is I figured a return rate on the savings account down here 7%. It's actually a growth rate. I don't know why they call it return rate. It's growth rate. So On the equity balance to start out with, 234 equity with the reverse, 157 equity with the forward. And what we're going to do is we're going to pop 1 year real quick and see what that does. Okay. What happened here was we did a $400 this is 12 months later, we did a $400 per month payment to the loan, which increased the line of credit. So now our line of credit after 12 months is about $16,000. And then with the rest of our savings, we contributed those to a savings account. And that savings account is this part right here. So we're looking at with the savings that we have and the $400 per month voluntary optional payment to towards the loan balance, then that's what our financial situation. So let's go 4 more years and see. We'll compare apples to apples. One, two, three, four, five. There we go. Okay. So after 5 years, equity position in the forward mortgage, if we went with the forward, 291, basically 292,000. Equity position with the reverse mortgage is about $297,000. In terms of liquidity, we have our savings account grew it, compounded at 7%, gives us $235,000, 235, 326. On the reverse side, we've got our savings has grown to about 203,000, but our liquidity is up to 242 because we've been making that monthly $400 per month payment. Now we have a line of credit that's at 39.8 approximately. That's 5 years into it. So only 5 years in, our liquidity position looks comparable, right? Equity position also looks comparable. 1, 2, 3, 4, 5. Okay, so we're 10 years down the road. We've made 10 years worth of payments on the 30-year mortgage. We're 10 years older. Youngest borrower is 83. Equity position in the home, $452,000. The equity's sexy and great and all, but you can't get to it without a loan. So in order to access this equity in this position, you're going to have to qualify for some form of a mortgage. On the reverse side, equity position is a little bit lower. And we're at 452 over here. Less equity in the home at 379.10. But our line of credit is about $75,000, and our liquidity position is 450. So now, if there's an emergency in life 10 years from now, what would you rather your mom have? 450 here or 330 here? I want my mom to have this one. That's what they chose. We go 20. Let's go 5 more years. 5 more years. Okay. Liquidity here, 473. Liquidity. Whoa. They chose this one. All right. Go back to this.
Hey, Kirk, before
Yeah.
you asked about questions, Jenna did have a question, or Jana. Her question, and she can chime in here, is she has a client who owns a duplex. Can she use a reverse mortgage on it?
If the reverse mortgage is her primary residence, then the answer so far would be yes.
Okay, I think that's all the questions we have.
Okay. So from the perspective of the realtor, if you just understanding a little bit about the reverse mortgage, hopefully you can see that potentially more buyer prospects can now buy because they might have equity in their home that they didn't realize they could use without qualifying for a forward mortgage. And if they don't have, that significant income, or maybe the credit score is not sexy enough, they might not qualify. Some borrowers are going to have more buying power, which is going to give them more buying choices, more areas, more home. Builders like it because if somebody comes in to play cash and they run out of money, they can sell upgrades all day long because now they can buy 50% more house or 10% more house. And I don't do a lot of work with builders yet, but I'm guessing they make a lot more money on those add-ons, those upgrades and that sort of thing. Just a guess. More willing sellers can sell now because, like I said, they don't have to qualify for a forward mortgage. They could potentially qualify for a reverse. This is one thing I didn't mention about Juan and Louisa. There's a two-story house. Two-story house. It's going to need a roof. It's going to need a new HVAC. There's trees everywhere on that lot. So either he's getting on the roof to clean those gutters, or they're paying somebody to do that. So there's currently right now, last couple minutes, there's currently more than 5,000 houses in Pierce County that are 2 stories or more, whose owners are 65 years or older, and they have more than 60% equity in their home. There's a lot of those people who would likely qualify for a reverse for purchase, should get out of that old, nasty house that's full of nothing but risk and liabilities for falling and tripping and all that kind of stuff, into a house that's much better, much newer, got all that stuff taken care of. Last thing, generational gratitude business. Hey, you took care of mom. Can you sell our house? Happens all the time with reliability. All right. Last things. Handful of resources for you. I'll just pop these in here. You can get my email address from just about anywhere. All of the socials: Facebook.com/Kirk Rau, Twitter.com/Kirk Rau, LinkedIn, whatever it is, /Kirk Rau. And I have a handful of books. I have a great book that's really easy to read for people that just really addresses the most common objections, and that's Harlan's book, Cinderella. I have a handful of brochures that are fantastic. I have the H4P toolkit, the reverse for purchase toolkit that is put out by NRMLA, which is an industry organization that I belong to. And then Trish Stone, an agent that I work with, she said, "Kirk, just give me a flyer. Just give me 1 page. So with a bunch of scenarios on it, that if I see that, I'm going to know that I should probably talk to you." And so I have a little 10 scenarios, 1-page flyer that I can shoot out to you as well. How we doing? Look at that. We got 2 minutes left. I literally sped through and jammed through a ton of information. I'm sure you probably have questions, and there might have been some holes in there. But that was 3 or 4 hours worth of stuff. On the right is my contact information. There's all my stuff. I don't think that's actually my office number, so don't pay attention to that. I apologize. Information for contacting me on the right. On the left, if you grab your phone, which I'm sure it's right there, right by your computer. Grab your phone and take a picture of that. That'll take you to my website. There's 5 or so different videos there that just explain how my approach is pretty different from most lenders.
Well, Kirk, I just want to thank you. I think everybody thank him for a very informative presentation. After this class, Kirk, I will go out and send everybody your contact information and your YouTube channel, your website, so that they can reach out to you with any further questions they may have. That work?
Yeah, that works. If you go to, if you're on Twitter, or even if you Google, I think it's #ReverseKirk, a handful of videos. I've created some reverse mortgage general information videos that you could be able to find also.
Super. All right. Well, thanks for everybody for joining us. Have a great day. Thanks again, Kirk. And we'll
Thank you.
follow up with an email here shortly.